hey, left right out. We just had a Fed meeting, and things are transpiring the way that we predicted. Maybe down the timeline, I thought this thing would be cracking a lot earlier when I said like 1.25, because they got to 2.25 back, a few years ago, and then things started cracking. I thought it was 1.25. I keep saying, I know I keep apologizing that was wrong. I don't think, maybe it wasn't wrong. Maybe there was the first cracks when we started seeing the crypto space start going. Then as you get further past that 2.5, once you get past the prior 30 years, some of these old bonds, that you actually have that crack happen. We just now are seeing it in these banks. But one of the things I want to talk about is not necessarily what Powell said today, which is probably complete nonsense almost, or what Yellen has come out and said, that they're not raising the FDIC insurance, whatever. There's a systemic risk here. But what I wanted to talk about a little bit, and then go into why this thing is happening a little bit more. My camera is kind of shaky there. One, some of the guys that I really respect. I mean, some of them that I watch all the time, that I would just if I can't, they're just super knowledgeable people. They've kind of got this wrong. They've gone on kind of a side topic on this. It's not wrong. It's just they're not identifying the chief reason why this is, or the first node in the mechanism of or series of events that has caused this. Well, not the first node. I mean the node nearest the collapse, because you can go way back and you can always go to the Federal Reserve, which they got that part. But a lot of them are talking about these dollar denominated assets that are European and overseas, which we have talked about, which I know about a lot, that there are almost like a ledger system. When they were talking about this ledger system, I was like, well, this is pretty much fractional reserve banking, only they literally don't have or maybe they actually have a reserves, I don't know, where they're just ledger systeming this thing out, which is essentially what we do here. It's called, like I said, fractional reserve banking. So what that meaning that is, they have they're just basically kind of like a collateral obligation, giving out dollars, or digital dollars in a sense, and there people are using that to purchase stuff, which is a big Ponzi scheme. So that definitely is happening overseas. But what's happening to these banks, and that's a whole nother thing. That is one of the dominoes that will collapse, and you'll have massive currency collapse, which is actually, when that collapses and all those fictitious dollars go out, it's very deflationary, because whether they are dollars or not, they're acting like that. These are being created out of thin air. That's the inflationary spiral up. And then when everything collapses, whether it be credit and everything, that's very deflationary when it comes to that. And in fact, when you have this huge up and down, you got a currency crisis. But anyway, so the bank thing that's going on now, yes, they were super woke. I heard some other guy talking about how woke they are and didn't have risk management, and that was one of the things. Okay, I get that. Yes, I'm with you on that, but it's not the chief reason. The chief reason has to do with not having a free market in interest rates, and having them set the way they are. So instead of a market constantly refining where that interest rate, where the price of the money is, and allocating capital to various places efficiently and effectively, you have a central bank that's holding these things down. So when this bank, SVB or whatever, Signature or UBS, or every bank almost, some of them can play it off a little bit better. Some of them are too big to fail. They don't really care anymore. They're just going to sell off these bonds anyway, or these debt assets to the Fed, and get the cash back. But anyway, so here we are. So you're getting these deposits in, you're getting this money in. Well, you're going to loan it out because you got to make money. You just can't sit on the deposits. Excuse me. Or if you're a pension fund, which we talked about this, and there's been a little red flare of a pension fund talking about this very topic. So, we've talked about in the past. We have all this money, you got to get some kind of return on it. So the only place to get yield, well, one, you either go into risky assets. Well, I would say that most of them don't. So what they do is they go out on the long end and get some yield. Now you're getting this yield on the long end. Now let's say interest rates pop up, then the value of that bond is now underwater. So, but the problem is you don't have any reserves, because you've either loaned the money out in various ways, or you've got locked into these assets, whether it be loaning out a 30-year mortgage, or a treasury, a 30-year treasury or even a 10-year treasury or whatever the case may be, that where your money is tied up in something. Granted, they're trying to get some yield, they're trying to get return, but the only reason they have to do that is because interest rates are artificially low down to zero. So anyway, they go out there and do that. Then all of a sudden, a little crack in the dam of somewhere else in the economy happens and somebody needs their cash. They go to try to get their cash. Well, it's not there. They just can't. And even normal folks in the last few years have had to do this. You can't just go pull out $5,000 if you want. And the banks are like, well, we don't have it. Or 10 grand or whatever it is. I've heard people try to do that and they can't get it. So anyway, these guys go in there, they're trying to pull out or transfer a bit of money. They can't do it. So what does this bank have to do? They have to go sell those long-term assets. And now they're underwater significantly. So they're taking severe losses in order to put the money back where these people can actually get to it to move it around. And then it's just a domino effect of people realizing that all that money is not there, right? So their deposits are gone. Especially if you're over 250,000, and even if you have 250,000, imagine, because there's a lot of more banks than SVB that's done this. Imagine if they all came down, or a number of them come down at once. Now we're seeing a lot of weakness in the regional stuff, but the FDIC can only take so much because they're so underfunded. I think we went over this last time, that it could get crazy real quick. But the canaries have died in the coal mine. We're at the doorstep of this crisis. The cracks on the dam are now widening. We can see it. It's there. The thing's going to go. And we just, I'm not going to try to time it, but now the cracks are widening. You see it. The water's starting to leak out. So just be ready. That's all I can say. I just wanted to say that because some people are bringing up some other currency stuff that, granted, it's super horrible overseas. Some people are bringing up the woke stuff. That's not those are issues, fine. But, the big issue is everything we've been talking about: central banking, the artificial manipulation interest rates, the investments these banks have been making with zero reserves or loaning out everything at ultra low interest rates, locking things in longer term, and then basically the Fed incentivizing banks and institutions, pension funds, individuals to go way out in the risk spectrum, or even when they think they're safe, way out in 10, 20, 30-year debt, and to get some kind of yield. So when this stuff happens, I mean, doesn't take it's not a rocket surgeon to figure this stuff out. Just you got to get your head out of your ass and get off Wall Street and actually listen to some guys that understand economics. You can figure this one out. I don't know why Powell and supposedly the smartest people in the world in a room can't figure this one out. That's why a lot of conspiracy theories get around. It's because, how can you be this stupid unless it's on purpose? So anyway, talk to you later. Peace.